Most people believe markets move on headlines, but silver's recent behavior exposes a deeper structural reality. Silver surged to $83.63, giving long-term believers a sense of long-awaited validation. Then, within hours, prices collapsed towards 73.72, shocking investors and shaking confidence. To most viewers, this looked like chaos, but in my opinion, it was pure market mechanics. Price did not fall because silver lost value. It fell because rules suddenly mattered more. On December 29th, the CME quietly raised silver futures margin requirements. Margins jumped from $22,000 to $25,000 per contract. That single adjustment instantly increased the cost of holding silver positions. Large traders were forced to either add capital immediately or liquidate positions. In thin holiday markets, forced selling never happens slowly or politely. It hits fast, aggressively, and overwhelms normal buying interest. That is how an 11% drop appeared almost out of nowhere. But the futures market story is only the surface of something much larger. Around the same time, Elon Musk warned silver is essential for industrial processes. That comment was not about price speculation, it was about supply risk. His concern connects directly to what happens on January 1st, 2026. China is implementing a new silver export licensing system. This system places government oversight on roughly 60 to 70% of refined silver supply. In my opinion, that shifts silver from commodity status towards strategic material status. Markets built on paper contracts are not designed for that transition. While American traders watched futures near $72, physical silver told another story. In Shanghai, real silver traded around $78.55 per ounce. That represents an $8 premium for actual metal. Either Eastern buyers are irrational, or Western paper prices are misleading. History strongly suggests physical markets are the more honest signal. This divergence is not new, but its scale is alarming. Every major silver rally faces rule changes at critical moments. In 1980, margin rule changes crushed silver positions abruptly. In 2011, repeated margin hikes pushed silver from 49 to 34. Those rallies were driven largely by investors and speculation. Today's silver demand is driven by industry, not sentiment. According to the Silver Institute, 60% of annual supply goes to industrial uses. Solar panels, electronics, electric vehicles, and medical devices all depend on silver. A single solar panel requires about 20 grams of silver. An electric vehicle uses roughly 25 to 50 grams. Multiply that demand across millions of units worldwide. Silver is no longer optional, it is required. Supply is not keeping up with this consumption trend. Global silver production has remained mostly flat for years. In 2025, the silver market ran a 300 million ounce deficit. That means demand exceeded new supply by an enormous margin. Silver embedded in technology rarely returns to circulation. Recycling cannot fix this shortage at scale. Now consider the structure of the futures market itself. COMEX warehouses hold roughly 451 million ounces total. Only about 140 million ounces are registered for delivery. That equals roughly 173 days of global industrial demand. In December 2025, deliveries reached record levels. During one 4-day period, 60% of registered silver was claimed. If this were a bank, confidence would vanish instantly. Futures markets rely on the assumption most holders never demand delivery. Industrial buyers do not have that luxury. Factories need metal delivered, not contracts rolled forward. Eligible silver could theoretically become registered, but owners are clearly choosing not to sell at current prices. That behavior signals withholding, not abundance. China's export licensing tightens the situation further. Only refiners producing 80 tons annually qualify for licenses. Smaller exporters are effectively excluded from global supply. China used this strategy with rare earth metals years ago. That move reshaped global supply chains permanently. In my opinion, silver is following the same path. If Chinese exports fall 50%, deficits expand dramatically. Analysts estimate an additional shortfall near 160 million ounces annually. Combined deficits could approach 460 million ounces per year. That exceeds total COMEX inventories entirely. Paper markets cannot solve arithmetic shortages. This explains why physical buyers ignore futures prices. Manufacturers choose guaranteed delivery over cheaper paper promises. The price difference becomes irrelevant compared to production shutdowns. We saw similar dynamics during the 2022 nickel crisis. Exchanges protected systems before honoring delivery obligations. That precedent matters greatly for silver investors today. There may be 50 to 100 paper claims per ounce available. That system works only until physical demand asserts itself. In my opinion, silver is approaching that breaking point. This is not about $73 versus $83 prices. It is about whether paper markets can still control price discovery. When physical scarcity dominates, possession matters more than contracts. Investors must ask whether they own metal or merely promises. We are not watching a normal correction unfold. We are witnessing a structural shift driven by industrial necessity. The coming months may redefine how silver is priced globally.